We have officially entered the event horizon. This is not a metaphor. This is not drama. This is not YouTube exaggeration. This is the precise moment where the old system stops functioning the way it used to. For years, the silver market existed in a controlled state. Prices moved, yes, but only within invisible boundaries. Every rally was capped. Every breakout was crushed. Every surge was sold with mechanical precision. This was not natural price discovery. This was engineered suppression. And today, that system failed. What happened was not a rally. What happened was not optimism. What happened was not retail excitement. What happened was a forced liquidation event that tore through the silver market with violence. Silver closed the previous session near $72. Within hours, it was trading at $79.25. That is a move of 734 in a single trading day. That is a gain of over 10%. Let me be absolutely clear, because this is critical. Commodities do not move 10% in a single day under normal conditions. They simply don't. Oil doesn't. Copper doesn't. Silver doesn't. When commodities move like this, it is not demand chasing price. It is price escaping control. This was not buying. This was forced buying. And forced buying does not negotiate. Somewhere in the world right now, a massive short position no longer exists. Not because it was closed responsibly, not because it was managed, but because it was destroyed. This was the death of a major financial entity's silver bet, and most people watching the price have no idea what actually just happened. To understand this move, you must understand how suppression works. For decades, silver has been one of the most shorted commodities on Earth. Paper contracts were created in volumes that dwarfed physical supply. Every ounce mined was matched with dozens, sometimes hundreds, of paper claims. This created artificial abundance. Price stayed low not because silver wasn't valuable, but because its market was flooded with synthetic supply. As long as price stayed within range, the shorts were safe. But when price crossed key levels, the math stopped working, margin requirements increased, losses accelerated, collateral evaporated, and then came the moment of no return. When a large short position runs out of margin, there is no choice involved. The system does not ask for permission. It does not wait for logic. It does not care about fundamentals. It executes. Every single contract is bought back at market price. Not limit orders, not careful entries, not strategic exits, market orders, at any price. And here's where timing made this move explosive. This happened during what traders call ghost liquidity, low volume, thin order books, few sellers. When forced buying meets thin liquidity, price doesn't rise, it teleports. There was nobody willing to sell at $73, nobody at $74, nobody at $75. The price jumped level by level, vacuuming upward, until it found sellers near $79. This is why the move looks vertical. This is why charts show gaps. This is why traditional technical analysis failed in real time. Because this was not a technical event. This was a structural failure. And now we are standing at the doorstep of $80 silver. That number matters psychologically, it matters institutionally, and it matters historically. Because above $80, the narrative breaks completely. At these levels, questions start getting asked. At these levels, physical supply matters. At these levels, paper promises get challenged. And here's the most dangerous part. This move did not resolve anything. It did not reset the market. It did not clear all shorts. It did not restore balance. It exposed weakness. If one liquidation event can move silver 10% in a day, what happens when the next one hits? Because there will be a next one. The system that suppressed silver for decades did not unwind gracefully. It cracked. And when systems crack, they don't heal. They fracture further. This is why calling this a rally is a mistake. Rallies end. Liquidation events change regimes. And regime changes do not go backwards. We are no longer in the market that existed last week. We are no longer operating under the same assumptions. We are no longer dealing with a stable pricing mechanism. We are inside a transition phase. And those are the most dangerous moments in any financial system. This is not the end. This is the beginning of price discovery. And price discovery, after decades of suppression, is never gentle. To truly understand what happened to silver, you must first understand how markets normally work, and then understand how this event completely violated those rules. In a normal market, buyers and sellers negotiate. A buyer says, I want to buy silver at $75. A seller says, I want to sell silver at $77. The market finds a middle ground. Price discovery is slow, incremental, and logical. But that is not what happened here. What happened was not negotiation, it was coercion. In a liquidation event, the market stops being a discussion and becomes an execution. When a short seller is forced to cover, they are not buying because they believe in silver. They are buying because the alternative is total collapse. Their account balance has hit zero, their collateral is gone, their broker is no longer protecting them. At that point, the system takes control. Every short contract becomes a mandatory buy order. Not tomorrow, not later, not when conditions improve, immediately. This is where most retail traders misunderstand what they are seeing on the chart. They assume price moved because buyers suddenly appeared. That is incorrect. Price moved because sellers disappeared. When forced buying enters a thin market, price doesn't climb smoothly. It jumps violently from one price level to the next, searching for liquidity like a drowning man searching for air. And silver at that moment had almost no air. The timing of this event could not have been worse or more dangerous. This occurred during a period of historically low liquidity, sometimes referred to as Ghost Week. Trading desks were lightly staffed. Many institutions were already positioned defensively. Volume was thin, order books were shallow. That is the exact environment where suppression mechanisms fail. For years, the silver market relied on a simple assumption, that there would always be someone willing to sell paper silver into rallies. But this time, when the margin calls hit, that assumption collapsed. No one stepped in. The result was a vertical move that shocked even seasoned professionals. Let's talk about the short position itself. Silver has long been treated as a controllable asset. Unlike gold, which carries overt monetary symbolism, silver was viewed as manageable. Its price could be capped through derivatives. Futures contracts could be rolled, losses could be delayed, exposure could be hidden. Over time, this created an imbalance. The paper silver market grew exponentially larger than the physical market. For every ounce of real silver, there were dozens of claims, sometimes more. This worked as long as confidence remained intact, but confidence is fragile. Once price crossed certain thresholds, models broke, risk managers intervened, margin requirements increased automatically. Positions that once seemed manageable became toxic in minutes. Losses compounded exponentially. A short seller loses money linearly as price rises, but margin requirements rise non-linearly. At a certain point, it doesn't matter how big you are. You fail. This is why the move looked sudden. In reality, pressure had been building for years. This was not a random explosion. This was a delayed detonation. Now let's address the most misunderstood concept in this entire event. Why 10% in silver is not just rare, it is catastrophic. Silver is a global commodity used in electronics, solar panels, medicine, defense, and industrial manufacturing. Its price is deeply embedded into supply chains. Stability is assumed. When silver moves 1 to 2%, manufacturers adjust. When silver moves 3 to 4%, hedges get rebalanced. When silver moves 10% in a day, contracts break. Producers cannot hedge fast enough. Consumers cannot reprice fast enough. Banks cannot rebalance exposure fast enough. This is why such a move sends shockwaves far beyond traders. It hits refineries, it hits manufacturers, it hits governments, and it exposes something far more dangerous than volatility. It exposes leverage. Leverage is the hidden force that turns small price moves into existential threats. The silver market was not just shorted, it was leveraged shorted. That means losses were magnified. That means margin erosion was rapid. That means liquidation thresholds were closer than anyone admitted. When the first large entity failed, it created a feedback loop. Forced buying pushed price higher. Higher price triggered new margin calls. New margin calls created more forced buying. This is how markets cascade. This is how systems unravel. And this is why calling this move done is dangerously naive. Because liquidation events rarely happen in isolation. They happen in waves. One entity falls, then another, then another. Each wave finds less liquidity than the one before. Each wave moves price faster, and each wave exposes how little control remains. Now let's talk about the psychological shift that just occurred. For decades, silver traders were conditioned to expect failure. Every rally was sold, every breakout faded, every surge reversed. This trained participants to short strength. That behavior is now lethal. In a market that has transitioned from suppression to forced repricing, old instincts destroy capital. Those who shorted this move, believing it always comes back down, were annihilated. And here's the key point most people are missing. This was not driven by retail investors. This was not driven by social media. This was not driven by hype. Retail was largely absent. This was institutions fighting for survival. And when institutions panic, they don't post on social media. They execute, silently, violently, without warning. This is why the move felt sudden to outsiders. The battle happened behind closed doors, inside risk systems and margin engines. By the time the public noticed, it was already over. But over is a misleading word. What ended was suppression. What began was uncertainty. And uncertainty is far more dangerous than volatility. Now consider where price sits now, near $79, $80. This is not just another level. This is a threshold. Above this level, physical silver becomes relevant again. Above this level, delivery risk increases. Above this level, paper promises get questioned. At these prices, industrial users start asking uncomfortable questions. Can supply be guaranteed? At what cost? For how long? At these prices, governments start paying attention. Silver is strategic. Silver is military. Silver is energy critical. And strategic assets are not allowed to spiral freely without intervention. Which raises the most important question of all: what happens next? There are only 3 possibilities. 1, price is violently pushed back down through emergency intervention. 2. Price stabilizes as the system absorbs the shock. 3. Price accelerates as further shorts fail. History suggests option 3 is the most dangerous and the most likely once suppression fails. Because once confidence is broken, it cannot be restored with words, only with liquidity. And liquidity is scarce. This is why the next open matters. If silver holds these levels, the market is forced to reprice risk across the entire complex. Gold, currencies, bonds, equities. Silver is small, but it is connected. And when small markets break, they often signal much larger failures ahead. This is not about silver anymore. It is about trust in pricing mechanisms. And that trust just took a direct hit. To understand why this silver move is not finished, and why it may, in fact, be only the opening act, we must move beyond charts, percentages, and headlines. We must talk about reality, because silver exists in two worlds. One world is paper, the other world is physical, and those two worlds are now drifting apart at an accelerating pace. For decades, the silver market has functioned on a convenient illusion that paper claims and physical metal were interchangeable. Futures contracts, options, ETFs, swaps, all of them were treated as if they represented real deliverable silver. In theory, they did. In practice, they never could. The reason is simple and uncomfortable. There's not enough physical silver to satisfy the promises embedded in the paper market. This mismatch was tolerated because most participants never asked for delivery. Contracts were rolled, positions were closed in cash, confidence replaced verification. As long as price stayed suppressed, nobody panicked. But now price is rising violently, and rising prices change behavior. When price rises slowly, participants speculate. When price rises violently, participants secure. They stop trusting abstractions. They stop trusting intermediaries. They stop trusting promises. They want metal. This is where the real crisis begins. Because the physical silver market is tight, far tighter than most people realize. Silver is not sitting idle in vaults. It is consumed. Unlike gold, which is hoarded and recycled endlessly, silver is used up. It is embedded into electronics, medical equipment, solar panels, batteries, weapon systems, and industrial components that are never recovered. Each year, a significant portion of silver supply disappears permanently. Mining does not replace it fast enough. New discoveries are rare. Production growth is slow. Ore grades are declining. This means the system relies on inventories, and inventories are shrinking. Now combine this reality with what just happened in the paper market. Short sellers were forced to buy contracts at any price. ETFs saw renewed inflows. Speculators re-entered. But here's the critical point. Every new paper buyer increases delivery risk. Because at some point, someone will demand the metal, and when that happens at scale, the system faces a dilemma it cannot easily solve. Let's talk about delivery mechanics. In futures markets, only a small percentage of contracts ever go to delivery. This is by design. The system assumes most participants will settle financially, but that assumption relies on confidence. Once confidence erodes, delivery requests increase. Even a small increase can overwhelm the system. Why? Because futures exchanges operate on fractional reserve, just like banks. They do not hold enough metal to satisfy all claims. They hold enough based on historical behavior. But history is no longer a reliable guide. This is why silver at $80 is dangerous. At these prices, industrial users cannot ignore procurement risk. They begin locking in supply, they negotiate long-term contracts, they reduce reliance on spot markets. At the same time, investors begin asking a different question. If silver is worth this much today, what happens if I can't get it tomorrow? That question changes everything. Now consider the ETF layer. Silver ETFs are marketed as simple exposure vehicles. Buy shares, get silver exposure, but most investors never read the fine print. They don't realize that many ETFs allow for cash settlement in extreme conditions. They don't realize that authorized participants, not retail holders, control redemption. In a crisis, ETFs protect the system, not the investor. This is not speculation. This is structure. And when prices rise fast enough, structures reveal their priorities. This is why physical premiums matter. During this move, premiums on physical silver products began rising faster than spot price. That is not normal. Premiums reflect scarcity. When premiums rise alongside spot, it means supply is tightening. Dealers hesitate to sell. Refineries delay quotes. Delivery times extend. This is how shortages begin, quietly before headlines catch up. Now let's address the elephant in the room. Can silver really go much higher from here? The answer depends on which world you're looking at. In the paper world, price looks overextended. In the physical world, price looks late. This disconnect is where repricing happens. Historically, when paper and physical markets diverge, physical wins. Because paper is a claim. Physical is a constraint. And constraints define price in the real economy. Now let's talk about something even more important. Trust. Financial markets run on trust. Trust that contracts will be honored. Trust that prices are fair. Trust that risk is distributed honestly. What just happened damaged that trust. Participants now know that silver price was not the result of free interaction. It was the result of pressure and control. Until control failed, once that realization spreads, behavior changes. Hedgers hedge differently, investors allocate differently. Institutions demand safeguards. This is why regime changes are so powerful. They don't reverse easily. After the 1970s gold shock, markets never returned to the old gold pricing system. After the 2008 financial crisis, trust in banks never fully recovered. After this silver event, belief in infinite paper supply will not return. And this leads us to the most underestimated force in markets: memory. Markets remember trauma. Risk systems get updated, exposure limits change, assumptions are rewritten. The next time silver approaches these levels, it will not be treated the same way. Short sellers will hesitate. Liquidity providers will widen spreads. Volatility will be priced in. This creates a higher baseline. This is how markets ratchet upward, not through optimism, but through fear. Now let's address the role of governments and central banks. Silver is not just an investment metal. It is strategic. It is essential for renewable energy infrastructure. It is essential for electronics. It is essential for defense. As silver prices rise, governments face a dilemma: allow price discovery and risk supply disruptions, or intervene and distort markets further. History suggests intervention is likely, but intervention has consequences. Price caps create shortages, subsidies create misallocation, stockpile releases create temporary relief. None of these solve the underlying problem, they delay it. And delays increase severity. This is why the next phase of this move may not be vertical. It may be chaotic: sharp rallies, violent pullbacks, policy rumors, regulatory responses. Volatility becomes the norm, and volatility attracts attention. Attention brings capital. Capital brings pressure. This is how small markets become big problems. Silver is tiny compared to equities or bonds, but its leverage is massive, and leverage amplifies stress. Now consider the broader context. Currencies are under pressure. Debt levels are extreme. Real yields are unstable. In such an environment, monetary metals matter. Gold is the anchor. Silver is the accelerant. Silver moves faster. Silver reacts harder. Silver breaks systems sooner. This is why silver often leads, not follows, during monetary transitions. What we are witnessing may not be a silver story. It may be a warning. A warning that pricing mechanisms built on leverage and trust are reaching their limits. A warning that scarcity is reasserting itself. A warning that physical reality is reclaiming control. The move to 79.25 was not the destination. It was the signal. And signals like this do not appear in isolation. They appear before larger shifts. The only question now is timing. Will the system stabilize temporarily, or will pressure continue building beneath the surface? Either way, the silver market will never be viewed the same again, because once illusion breaks, it cannot be repaired, only replaced. What most people fail to understand is that silver does not exist in isolation. It never has. Silver is a pressure point, a small, highly leveraged node inside a much larger financial network. When pressure builds elsewhere in the system, silver often reacts first. And when silver breaks, it sends shockwaves far beyond its own market. What we are witnessing now is not merely a commodity event. It is a systemic stress signal. To understand why this matters so deeply, we need to zoom out, far out, and examine how silver connects to currencies, bonds, equities, governments, and global trade. Let's start with currencies. Modern currencies are confidence instruments. They are not backed by metal. They are backed by trust. Trust that governments can service debt, manage inflation, and maintain stability. Silver rising sharply is not just a commodity signal, it is a currency signal. When silver jumps 10% in a day, it is not saying silver is valuable. It is saying currency purchasing power is being questioned. Historically, sharp moves in monetary metals precede currency stress. This is not theory, it is pattern. Silver reacts faster than gold because it is smaller, thinner, and more sensitive to marginal flows. It is the canary in the monetary coal mine. And right now, the canary is screaming. Global debt levels are unprecedented. Governments are rolling over obligations at higher interest rates. Fiscal deficits are structural, not cyclical. Monetary authorities are trapped between inflation and insolvency. In such an environment, metals matter again, not because of nostalgia, not because of ideology, because they exist outside the system. Silver's breakout is a reminder that not all value is digital, not all promises are equal, and not all assets can be printed. Now let's move to bonds, the backbone of the modern financial system. Bond markets depend on predictability. They price risk based on models that assume stability. Sudden volatility in metals disrupts those assumptions. Why? Because metals are often used as collateral. Banks, funds, and trading houses pledge commodities as margin. When prices move violently, collateral values change, haircuts increase, margin requirements rise. This creates stress. When collateral becomes volatile, lenders pull back. Liquidity tightens, risk tolerance collapses. This is how localized events propagate systemically. Silver's move may appear small compared to trillion-dollar bond markets, but its impact on confidence is outsized. Now consider equities. Stock markets have been conditioned to ignore risk. Central bank support, passive flows, and buybacks create an environment where dips were opportunities, not warnings. But commodity spikes change the narrative. Rising silver prices increase input costs. They compress margins. They complicate forecasting. Industries reliant on silver, technology, renewable energy, medical equipment, face immediate pressure. Solar panels become more expensive. Electronics margins shrink. Defense procurement costs rise. This matters to governments, which brings us to geopolitics. Silver is not just an industrial metal. It is strategic. Countries with access to silver supply have leverage. Countries without it have vulnerability. As prices rise, export controls become tempting. Stockpiling becomes attractive. Supply chains fragment. We have seen this movie before, with energy, food, and semiconductors. Silver is next. This is why governments watch metals closely, even when the public doesn't. Now let's talk about central banks, and what they cannot say publicly. Central banks are not supposed to care about silver, officially, but unofficially, they care deeply about signals. Silver moving violently suggests instability at the margins of the system, and instability at the margins eventually moves inward. Central banks understand leverage, they understand contagion, they understand that small markets can break big assumptions. This is why they monitor commodity volatility closely. But here's the problem. Central banks are increasingly constrained. They cannot easily raise rates without breaking debt markets. They cannot easily cut rates without fueling inflation. They cannot openly intervene in metals without admitting loss of control. This creates paralysis. And paralysis increases risk. Now let's examine derivatives, the hidden layer. Silver futures, options, swaps, structured products. All of these instruments reference silver price, but few involve physical metal. Their notional value dwarfs the physical market. This creates fragility. When volatility spikes, models misprice risk. Options go deep in the money. Hedging becomes expensive or impossible. Dealers widen spreads, liquidity providers retreat, volatility feeds on itself. This is exactly what happened during previous market shocks. From LTCM to 2008 to the COVID crash, silver's move carries the same signature. It is not smooth, it is discontinuous. That is the hallmark of stress. Now let's talk about psychology, the most underestimated force of all. Markets are not just numbers, they are narratives. For decades, the dominant narrative was simple. Silver is manipulated, but controllable. Rallies fail, shorts win. That narrative just broke. And when narratives break, positioning follows. Funds reassess models. Risk committees revise assumptions. Traders adjust instincts. This creates a lag effect. The full impact of this move will not be visible immediately. It will unfold over weeks and months. As strategies adapt, flows change. And those changes can sustain higher prices, even without dramatic headlines. This is why regime shifts feel confusing at first. People expect fireworks. Instead, they get instability. Now let's address the myth of mean reversion. Many traders believe silver must fall back because it moved too far, too fast. This belief is rooted in past behavior, but past behavior was shaped by suppression. Once suppression weakens, mean reversion no longer applies. Markets do not revert to manipulated means. They seek new equilibrium, and new equilibrium is rarely where the old one was. This is why post-breakout consolidation often occurs above previous ranges, not below. Now consider what happens if silver remains elevated. Mining companies benefit, but slowly. Production cannot ramp up overnight. Permitting takes years. Capital takes time. Supply response is delayed. Demand response is immediate. This imbalance supports price. Now factor in investment flows. Once silver enters mainstream attention, it attracts capital that dwarfs its market size. Pension funds, sovereign funds, institutional allocators. They do not need silver to moon. They just need it to diversify. Even small allocations can overwhelm supply. This is how tiny markets move dramatically. Silver is not prepared for institutional scale demand, which makes it dangerous. Now let's talk about control. Can authorities control silver price? Temporarily, yes. Permanently, no. Control requires credibility. Credibility requires reserves. Reserves require resources. And resources are finite. The more control is exerted, the more distorted the system becomes. Distortions accumulate. Eventually, release is violent. This is why the most dangerous phase is not the breakout. It is the response. If authorities attempt to suppress again, they may succeed briefly, but at higher cost. Each intervention weakens trust. Each failure emboldens challengers. This dynamic favors volatility. Now zoom out one final time. Silver's breakout is not the end of anything. It is a beginning signal. A signal that leverage is stretched. A signal that trust is thinning. A signal that physical constraints matter again. These signals tend to appear before major transitions. They do not tell us exact outcomes. They tell us direction. And the direction is away from abstraction, toward reality, toward scarcity, toward constraints, toward repricing. This is why dismissing silver's move as noise is dangerous. Noise fades, signals persist. And this one is still echoing. Every financial era ends the same way. Not with consensus, not with agreement, not with warnings being taken seriously. It ends with denial giving way to reality. And silver's sudden eruption was not the cause of the coming change. It was the confirmation. For decades, the global financial system survived on assumptions that were never stress-tested honestly. Assumptions about infinite liquidity. Assumptions about controllable markets. Assumptions that leverage could grow faster than reality without consequence. Silver was one of the last pressure valves holding that illusion together. Now it has blown. The question is no longer whether silver was suppressed. That debate is over. The real question is far more uncomfortable. What happens when a system built on control realizes it no longer controls the outcome? To answer that, we must confront the final stage of every manipulated market, the transition phase. This is the phase we are entering now. A phase where volatility is no longer an exception, but a feature. A phase where price discovery does not move politely. A phase where confidence fractures unevenly, and uneven fractures are the most dangerous kind. Let's start with the most important misconception that will dominate headlines in the coming weeks. This move is finished. It is not. Major market events do not conclude cleanly. They unfold in chapters. Each chapter introduces new participants, new fears, and new behaviors. The first chapter was denial. The second was forced liquidation. The third is reassessment. We are now entering the fourth, adaptation. Adaptation is where damage becomes permanent, because once participants adapt, the old equilibrium never returns. Risk managers update models. Traders change instincts. Institutions rewrite playbooks. And the one thing that never survives adaptation is complacency. Silver will now be treated differently, not because of ideology, not because of conspiracy, but because it proved something fundamental. It proved that the system can break under stress. That knowledge cannot be unlearned. Now let's examine the three realistic paths forward. Not predictions, but scenarios. Scenario 1, controlled retreat. In this scenario, authorities and large institutions manage to slow the momentum. Price retreats, but not violently. Volatility compresses gradually. Narratives shift towards stability restored. This would require coordinated liquidity, disciplined intervention, and favorable macro conditions. Possible? Yes. Likely? Only temporarily. Because controlled retreats do not resolve structural imbalances. They postpone them, and postponement increases future intensity. Scenario 2, violent repricing. This is the scenario markets fear, but rarely price correctly. In this path, additional short positions fail, delivery stress increases, physical premiums widen, volatility expands rather than contracts, price overshoots, not because of speculation, but because the system lacks shock absorbers. This scenario forces broader repricing across assets. Currencies weaken. Bonds destabilize. Policy responses become reactive. History shows that once suppression fails, overshoot is common. Not guaranteed, but common. Scenario 3, extended instability. This is the most subtle and arguably the most dangerous outcome. Price does not explode. Price does not collapse. Instead, it becomes erratic. Sharp rallies, sudden drops, conflicting signals. This environment exhausts participants. It erodes confidence slowly. It discourages leverage and rewards caution. Extended instability changes behavior more effectively than crashes. It forces long-term repricing without dramatic headlines, and markets hate it. Because instability cannot be fixed with a single intervention. Now ask yourself, which of these scenarios requires the least control? The third. And systems under stress tend to choose the path that requires the least effort, not the best outcome. This is why silver's future may look less like a straight line and more like turbulence. Now let's address the emotional dimension, because markets are ultimately human. People want closure. They want a moment where someone rings a bell and declares the crisis over. That moment rarely comes. Instead, reality seeps in gradually. A failed hedge here, a missed delivery there, a widened spread that never narrows. This is how trust erodes. And trust is the real currency of financial systems. Once trust declines, participants demand compensation for risk, higher premiums, lower leverage, shorter time horizons. All of these support higher prices, not through excitement, but through caution. Now consider the role of media. Mainstream narratives will lag. They always do. At first, silver's move will be framed as anomaly, then as speculation, then as reaction to some external headline. Rarely will it be framed as systemic stress, because systemic explanations are uncomfortable. They challenge authority, they challenge competence, they challenge narratives of control. But markets do not care about comfort. They care about constraints, and constraints are tightening. Now, let's return to the phrase that began this entire discussion. The game was rigged, until now. This does not mean the game is suddenly fair. It means the rigging mechanism lost precision. And imprecise control is worse than no control at all, because it creates uncertainty without transparency. Participants don't know where the floor is. They don't know where resistance truly lies. They don't know who is solvent. This is how liquidity disappears. Liquidity does not vanish because assets are bad. It vanishes because trust is insufficient. Silver just tested trust, and trust blinked. That matters. Now let's speak directly to the viewer, the investor, the trader, the observer. This is not about chasing price. This is not about prediction. This is about awareness. Awareness that old assumptions are no longer reliable. Awareness that volatility is not noise. Awareness that small markets can expose big truths. Silver did not cause the problem. It revealed it, and revelations do not reverse themselves. They change perception permanently. This is why history books are written after events, not during them. We will not know the full significance of this moment immediately, but we will recognize it later as the point where suppression became expensive, as the moment leverage lost its invisibility, as the signal that physical reality was reasserting itself. Every era has such moments. Most people miss them, not because they are hidden, but because they are uncomfortable. Silver's move was uncomfortable. That alone makes it important. Now let's end with clarity. This is not financial advice. This is not a call to action. This is a warning. And warnings are valuable precisely because they arrive before consensus. Markets do not reward those who react last. They reward those who notice early. Silver has spoken, not loudly, yet, but clearly. And clarity in times like these is rare. The game did not end. It changed. And change, once begun, does not ask permission to continue.